Hello, everyone. Welcome to this free cash course on investment banking, your ultimate guide to understanding one of the most exciting and high stake industries in finance. Whether you are dreaming of a career on Wall Street, curious about how investment banks work, or just want to learn how companies raise billions, this 14-part series has got you covered. We'll break down everything from investment banking, equity research, and asset management to mergers, acquisitions, and even the hierarchy of roles in an investment bank. By the end of this 1 hour free course, you'll not only understand how investment banks actually work and also how it shapes the global economy. So, if you're ready to dive into this world of high finance, hit that like button and let's get started. Hello friends, welcome to this investment banking tutorial from Wall Street Mojo. This investment banking overview program has been designed to provide you with a glimpse of what investment banking is and how does it function. We'll quickly take you through the number of integrated functions that an investment banking carries out. Here we will discuss what is research, what sales and trading implies, what is it to raise capital, how do investment banks actually help in underwriting and market making activities, how do they help in M&A activities and in restructuring activities in case of bankruptcy. In this investment banking program, we'll start with a very basic concept of what is an investment bank vis-a-vis what is a commercial bank. When covering research as one of the fundamental investment banking functions, we'll look at questions like what is equity research, why are buy and sell recommendations actually looked at, who are the clients, and how do research actually makes money for an investment bank. When we talk about clients, asset management companies or AMCs are one of the largest clients for the investment bank. And in this debate of, AMCs versus research, we'll come across yet another aspect, which is something called as a buy side and a sell side, the jargons that you must know of. Now, as we move further, we'll look into sales and trading, an integrated part of research that we will explain you in detail with the help of an example. Another activity of an investment bank is to help raise capital by debt route or maybe by equity dilution through an IPO or a private placement. We will also look at what all an investment banking actually does when they help companies raise capital for growth or acquisition or maybe for global expansion, and also what exactly initial public offering or IPOs and follow-on public offerings or FPOs mean, and also what private placements are. Next, we will also be introducing you to the jargons on underwriting and market making. These are very important functions, often misunderstood. Then to an extent, when we talk about M&A activities, it is considered the heart and soul of investment banks. We will flip through how investment banks actually help companies do a transaction and analyze it from a creative and a dilutive side. We will, in short, also focus on how investment bankers go about making a pitch book for an investment bank, which helps them present their case to potential investors. And lastly, we will discuss restructuring and reorganizational related aspects where investment banks actually play a major role. So when we talk about all of these set of roles from the point of view of learning investment banking, it is important for us to understand the overall aspects of how the hierarchy within an investment banks actually work. Hence, we will quickly check out who is an associate, who is an analyst, who is higher on the chain of hierarchy, vice president or the managing director. What are their roles and responsibilities? In short, we'll be looking into these set of questions through an investment banking course, and do note that this is just a bird's eye view of the topic, with each field being a science in itself. Thus, to understand each aspect of investment banking, you must be dedicated and not treat this course as a comprehensive course. Though this is just a basic introduction to investment banking, it will pave your path towards expanding your knowledge on the subject without getting stuck. So be ready for a journey of exploring investment banking in this video series. Let's begin. Hello friends, welcome to this investment banking tutorial from Wall Street Mojo. In the last video, we discussed what are the things we would be discussing as we go through this program in detail. But before we understand what investment banking is and how do investment banks function, we must have an idea of how it differs from a commercial bank or a retail bank, and how do these commercial banks or retail banks work. The first thing, therefore, we need to kind of understand is what is a commercial bank and what are the aspects of commercial bank that differs from the investment bank. Let's now begin with looking at what the commercial bank is. Commercial banks are financial institutions that you know better off as retail banks. An example of commercial bank or retail bank could be something like Citigroup or JPMorgan Chase Bank. Then we can also have HSBC, and there's a whole list of commercial banks. But the primary question here is that what are commercial banks and what is their responsibilities? How do they earn money? So let me put this in a very, very crude example. Let's assume that this is a commercial bank and there are two different set of parties involved. Think of you and me. When we have excess cash, we kind of deposit that money in the bank, right? So we are essentially depositors. A bank is a place where they collect money from various depositors. These depositors can be individuals or they can be corporates as well as business guys. So essentially what we are saying is that the banks actually collect dollars from these depositors. But what does the depositors get in return? Firstly, they know that the money which they have deposited is safe, right? And secondly, they are assured of earning something called as the interest rate. We can call this as interest on deposit. So let's say that you have deposited $100 and the interest rate is 5%. The bank at the end of 1 year will pay you not only $100, which is your initial amount, but you will also have $5 in your account, which is your corresponding interest payment. That makes it $105 at the end of 1 year in your bank account. Now, this is one side where bank actually sources money. The second is basically where they deploy this money. And how do they do that? The answer is loans. Loans in the form of, home mortgage loans, or there could be individuals who would like to have car loans or personal loans, or it could be any other format of loan. So there is commercial banks that offer loans to individuals as well as loans that are also given to corporates. So what we are essentially saying is that banks actually collect money from depositors and give them to those who are in need of money. But then what is the benefit for the bank here? The benefit for the bank here is that they earn an interest income in this case. So the banks actually earn money by ensuring that the interest on loans that they earn is greater than the interest on deposits that they give. The interest income should be more than the interest expense of it, right? So if the bank is able to manage or ensure this, the bank will be profitable. So traditionally, the bank has been doing this kind of business where they are giving loans, and this is something like a low risk kind of business, and it is called as a commercial or a retail bank, right? So with this understanding of a commercial bank, let us now move forward and look at what is an investment bank. First and foremost, please note that the investment banking is different from the traditional or the commercial banking which we have earlier referred to. Investment banks do not take deposits like the way traditional bank does, or they don't actually pay interest or guarantee safekeeping the money of the depositors. So what do they actually do? To understand investment banking better, let me give you an analogy with respect to a property broker. Now, who is a property broker? Let's assume that on one side there are buyers of an apartment, and then on the other side there are sellers of an apartment. So there are buyers as well as sellers of the apartment. Now, obviously, they would like to transact and make this market happen. Now, on the one side, when the buyers, who are individuals who are seeking the sellers, sometimes, in fact, many a times, it becomes very difficult for the buyers to do all the due diligence with respect to the apartments, or maybe look at the financial considerations and negotiate them. In fact, sometimes searching for apartments is also a problem for them. So what happens is that these buyers may actually get in touch with people called as property brokers. Now, these property brokers will actually do a couple of tasks, like they would identify how many sellers are there in the region. They would communicate and kind of make a checklist of the legalities associated with the apartment. They will do the complete due diligence and also look at the financial considerations and research, and depending on the requirements of the buyer, they would kind of suggest the properties. So the property broker is someone in between who is doing all these tasks. Now, how do these property brokers normally make money? They earn through commissions, and these commissions are primarily on successful transactions. So let's say if a buyer has bought a flat or apartment from a seller at $10 million. So a certain percentage will actually go as a part of earning for the property broker in the form of commissions or fees. So this is how a property broker functions. Now, having understood how a property broker functions, let's understand the functioning of an investment banker. I call an investment banker a financial broker here. So instead of property broker, I'm calling this as financial broker. What his job essentially is to make the buyers on one side and the sellers on the other side meet somehow. Now, I quickly changed the definition of buyers and sellers here in this context because I'm talking about investment banking here, right? Now, think about a company, okay? Instead of buyer or seller, we can call it a company. Let's name it ABC that wants to raise funds. Raising funds means that they require finances, let's say, for making investments and expanding their business from a very small city to having a global presence altogether. So for that, they require funds. So obviously, there are two approaches available to them. One of them is that they can approach a bank, and second is that they can raise equity from the market through an IPO. So doing an initial public offering means that raising money from the market. So let's assume that they don't want to go to the bank via a debt route for raising further funds. Instead, they're evaluating equity dilution. By equity dilution, they mean they're ready to give a share of their company to a certain set of investors via an IPO. Now, if a company ABC wants to kind of go ahead with this, they will find it really tough because of a couple of things. Like there are legalities associated with it, which they might not be aware of, or even if they understand the related process, then they may not even know how to execute it. Also, at what price or valuation of shares should they be available to the investors? Again, they may not be aware of that too. So what options does company ABC have? So they basically contact someone called an investment banker, and the role of an investment banker here is to do all of these tasks, to check all the legal options, look at the processes, perform valuations, and also identify all the set of investors for this IPO. The investment bankers are sophisticated financial brokers. In fact, they're connected with the investors and they help these set of companies raise funds, and they also understand the checklist of raising funds to an IPO. So this was a very small example where, investors are on one side and the company is on the other side. So the next question that arises is, how do investment bankers earn money? Investment bankers earn money by commissions, like the way property brokers used to earn. They earn commissions on the amount of funds that are raised for the company ABC. So this is one of the services of investment bankers. The other set of examples could be related to mergers and acquisitions. So let's say there is a company called ABC and they want to merge with another company called DEF. Now, the problem with these two set of companies would be that they may not be equipped enough to handle all the regulatory aspects of the merger, as well as do the appropriate calculations in terms of valuation or prepare financial model. So what investment banking firm does is that they act as an intermediary and advise on the possibilities of the merger, why it should happen, what are the possible synergies, etc. And in fact, a critical aspect of investment banks is that they help largely in negotiating the price. So, if the price is high, then how do they talk to the clients to make the two of them, buyers and sellers, meet at one point? So they are expert negotiators as well. For that, again, they charge commission. So as a result, they charge a certain amount of commission, let's say 1%, 2%, 3%, etc. So in a nutshell, think of property brokers, and property brokers' role is just a kind of, help the buyers and the sellers identify the most suitable deals and be in between. Property brokers actually add a lot of value by helping the buyers search as well as the sellers also to identify the buyers. Likewise, investment banking also does the same and adds a lot of value by bridging the gap in between. We hope you had a good time during this lecture and exploring the differences between what is an investment bank and a commercial bank. Besides helping companies raise funds or in merger and acquisition activities, investment banks do a lot of other things as well, which we'll be discussing in the following lectures in the upcoming videos. Hello friends, welcome to this investment banking tutorial from Wall Street Mojo. Now that we know exactly what investment banking is, let's now quickly browse through the other departments and their workings within an investment bank. The first and foremost behind everything is the equity research department. And when we talk about research, the primary job is to come up with the buy and a sell recommendation on the stock from a long-term perspective. And the idea here is that they should be able to advise their clients on whether they should buy the stock or sell the stock from the stock market. So the first question, what we'll actually try and answer here is, what exactly is equity research? When we talk about research, it all starts by conducting a fundamental analysis, like doing ratio analysis, doing a lot of valuations, including free cash flow to the firm, and also applying relative valuation techniques. So what exactly is research and how do they actually help make money for an investment bank? That's the second question we'll try and answer here. Before that, we must first understand for whose consumption are we conducting this research. They're basically clients, and one of the largest set of clients are the asset management companies or the AMCs. So we'll try and understand what AMCs are all about. And when we talk about equity research on one side, and AMCs and institutional investors or clients on the other side, the former, that is the equity research, becomes the sell side and the other one becomes the buy side. So as a newcomer to investment banking, you must understand the differences between a buy side and a sell side. But before that, let's first and foremost start with an understanding of what equity research is. Let us now look at the overall workings of a brokerage or a research department. Well, the equity research department performs stock research, right? And stock research basically means that they look into the fundamentals of the company, going through the annual reports, identifying, whether the company is good or bad from fundamental point of view, looking at the future, and coming up with the buy and sell recommendation on the stock. So essentially, we are saying that the research department does the valuation analysis on the company and recommends the purchase or the sale of the stock. So these stock recommendations are being done for various kinds of clients, including the pension fund managers, portfolio managers, retail investors, and once they're convinced with it, the clients will actually give orders to execute the buy or a sell through the sales and trading department, which brings us to yet another important division of an investment bank, the sales and trading department, the function of which we'll actually learn in a minute. But before that, let me ask you a simple question. Who are the clients? So as we understood that the clients could be pension fund managers or portfolio managers, but the clients can take different forms, different names altogether and exist in different kinds. Think about clients who come from background of being an individual. Say they don't represent an organization. Let's say it's you and me. I may want to invest in Microsoft stock. So I'm an individual investor, right? So essentially I have money and I may want to invest small amounts of money through my account. This is one class of investor. These are called as the retail investors or the individual investors. But please note here that when we talk about investment banks providing its research services, we are talking about guys who are major investors, like the high net worth individuals or the HNWIs who have millions and millions in their bank account and who would like to have some professional on the board to manage it, right? But how about institutional investors? So what do we understand by institutional investors? Think about institutions like the mutual fund. A mutual fund is nothing but a fund or a portfolio created by public through an organization. So these pool of funds are then invested in a certain mandate as defined in the investment policy of the mutual fund. Likewise, institutional investors could be large companies having large amount of cash on the balance sheet. Other examples can be insurance companies, pension funds, hedge funds, etc. So when we talk about investment banks, investment banking's equity research department typically caters to the needs of the institutional investors. They may not cater to the needs of you and me, that is the individual investors. So let me give you a brief about, how a financial model looks like and what is the actual job of an equity research analyst within a research firm. So the research department's primary job is to prepare financial models where they analyze the historicals of the company and see their margins and analyze the fundamentals. They also forecast and come up with forecasted numbers for the income statement, balance sheets, as well as cash flows. And if you look at their forecasting techniques, these are very professional techniques, and it takes a lot of time for someone to build these kind of models. And at the end of the day, there's one single objective, that is to come up with the share price of the stock, which is the fundamental price or the fair price. So depending on the share price that comes using these valuation models, research analyst recommends the final target price, and thereafter they prepare the research reports for the clients. With this understanding of research, let us now move forward and look at how do they really make money. When we talk about an investment bank, we know that there is an equity research department, and then we also have the sales and trading department. Though there are different other departments as well, but the one which we are exploring here as of now are the two, research and sales and trading. Now the question here is, how does equity research make money? The research professionals are the ones who give buy and sell recommendation to the clients like the institutional investors, right? Now, what these guys in the research side are doing is they are basically preparing recommendations in the form of reports, and they're advising clients on whether they should buy or sell, right? So as my question was that how do they make money? Do you foresee a possibility that these reports come at a price tag, or let's say $100 per report or $200 per report, and they sell it directly to the clients? Is that the case? Or do you think that the earning channel from these clients is slightly different? If we assume that these reports are actually paid for, then we would be assuming wrong. These reports are not paid reports. In fact, in most cases, these are given for free. So giving these reports, which are prepared after doing some deep analysis, referring to a lot of databases, spending time, it definitely involves money, right? But the investment banks are eventually giving it for free. So how does this whole process works for an investment bank and makes them money? Let's see how. Let's say if you are a technology analyst, and let's assume you are covering a stock called Microsoft. And for that, you have given a buy recommendation. Now that you are in a discussion with one of the clients like the mutual funds, and if this mutual fund is convinced with your story about how and why Microsoft is a buy, it will be excited to buy this stock, right? So maybe one reason is that the things or the elements that you have looked at in terms of research were overlooked by the other research houses. And now this mutual fund is kind of convinced that this is a very strong buy. So what will they do essentially? They want to own the stock now. Ultimately, let's say they want to buy Microsoft shares worth $10 million. So how will these trade orders get executed? Here it is $10 million or maybe 20 million, 30 million or maybe 100 million. So this mutual fund, do you think they will go in the open market and find sellers of Microsoft shares? No, they will not do that. They will instead approach the same investment bank to execute the trade for them. So the execution responsibility again lies with this brokerage firm. But the research guys, right, they do not have the skills to execute the trade. And that's where the entity called as the sales and trading comes into picture. So here it is the sales and trading department, which we will again discuss in a bit more detail. But for the time being, let's assume that there's a trade worth $10 to be executed for this mutual fund. It will be done through this sales and trading department. And on this, basically the brokerage house of the investment bank will charge commissions, right? So let's assume 1% or 2% is its fees. So now this is how equity research guys are actually making money for the investment bank. And this is why the sales and trading guys are needed to execute this trade. So we'll discuss all of that in our upcoming video tutorials, so stay tuned. Hello friends, welcome to this investment banking tutorial from Wall Street Mojo. Now that we have understood pretty much in a nutshell that research departments make money basically indirectly through the clients like the institutional investors or the asset management companies. Now let us look at asset management company in a bit more detail. So asset management companies or AMCs can be classified as one of the institutional investors. And what do they do exactly? Asset management companies basically invest pool of funds of clients into various securities. So these securities can be bond securities or company based securities, that is the stock equity based securities. And asset management company essentially collects money from the public and builds as a pool of investments. Let's say maybe $1 million or $100 million or maybe $200 million or maybe a multi-billion fund. So depending on the size and the mandate, they invest the pool funds of clients into various securities. An example could be an asset management company like a mutual fund that invests in technology stocks. So obviously you and me as an investor may invest in mutual fund of one of the companies, and that mutual fund will be managed by a portfolio manager here. So there is a portfolio manager who directs the pooled funds into various securities, and they try to earn a reasonable return on investments for their clients. So let's now see how AMCs make money for themselves. So they make money by charging commissions or fees depending on the size of the fund that is they are managing. So if let's say the fund size is $100 million, for example, the management fee may be around 2% or 3% of the overall asset under management or AUM. And the manager who manages the investments or takes investment decisions is called the portfolio manager or the fund manager. And the important part of this asset management or asset management companies is that they provide a lot of diversification because they have a large pool of resources as compared to individual investors. So I may invest only in Microsoft or maybe Facebook, but the mutual fund that invests in technology stocks may provide more diversification benefits because they have large funds to invest across domains and they're professionals, right? So they can do a lot of risk return analysis and kind of diversify their large portfolio, which will in return ultimately mitigate my investments in the mutual fund, right? So that's how basically the asset management companies actually work. I hope this tutorial helped you understand how AMCs work and how they make money through the clients they serve and how their presence help investors in mitigating risks with diversification. Hello friends, welcome to this investment banking tutorial from Wall Street Mojo. Let us now look at the differences between what is a buy side and what is a sell side. Many a times I have seen students or participants getting confused between the two and why are they kind of used in the context of investment banking. When we had heard earlier about investment banking, you remember we said that investment banking has an equity research department as well as a sales and trading division, right? So think about research division that is preparing research and advice for clients like the institutional investors. In short, equity research department produces research reports to be consumed by clients. So whenever you see this report, about a stock recommendation from a brokerage firm, think of this as sell side because what they're doing is essentially selling ideas. Please note there could be some neutral brokerage firms, independent brokerage firms who sell reports as well at a price tag. But remember, investment banks are not selling research reports. They're selling ideas or recommendations to the clients, and these ideas are communicated for free. So that's how a sell side is evident in the case of these banks. Okay, now think about a buy side. Buy side is nothing but the client who are on the institutional side. The clients constitute the buy side who have a pool of funds where they invest in stocks and bonds. So on the buy side are the ones who buy stocks and bonds, and that too in large volumes of security for money management purposes. Now the next question that appears is, what are the examples of buy side? So let's take a look at a couple of them. Hedge funds, mutual funds, insurance companies, pension funds, to name a few, are actually buy side. If you look at hedge funds or mutual funds individually, you'll find a fund manager who will interact with these brokerage firms for ideas. So the brokerage firm is giving ideas to the mutual funds. The fund manager basically evaluates those ideas and then decides on the investments. Please note that the fund manager of a mutual fund buys securities on behalf of his clients, and therefore they're termed as buy side. I hope with this you were able to understand the key differences between buy side and the sell side. I can't wait to see you in the next video, as we have another interesting concept waiting for us in our investment banking series. Hello friends, welcome to this investment banking tutorial from Wall Street Mojo. Research and sales and trading division play a very important role, and they work in a very integrated fashion. So it's very important for us to understand what is meant by sales and what is meant by trading, because it is very important money making mechanism for the investment bank. So let us now take a look at how the sales and trading department within an investment bank works. So when we're talking about investment bank with a research department as well as a sales and trading department, so what happens is that when the research department comes with its own set of reports recommending the buy and sell on a specific stock, they basically talk to the institutional investors, or they send their reports directly to them as the first thing in the morning. Now, these institutional investors may get convinced with the idea of trading on such securities because they may believe in the recommendation of the research department, and they may look forward to executing certain trades. Say, for example, a particular mutual fund may be interested in buying Microsoft stock of, let's say, to an extent of $10 million. So what happens is that when these large deals actually happen, $10 million, $20 million, etc., what the investment bank must do is that they must try to match the buyers with the sellers without affecting the actual execution price to a great extent. So what I mean here is that, let's say if there is an order of $100 million on Microsoft, that's a very large order to look at, right? So if the large order starts getting executed, obviously the share prices will move up and up because there are very few sellers comparatively. However, the buying momentum is still on. So with this, Microsoft prices may jump by 5% or maybe 10%. Of course, I'm speculating on that part, but yes, it may jump. So what an investment bank does here is that they come in between and they match the buyers and sellers, and they try to keep the execution price or the price at which they buy at a minimum. Investment banks may also buy and sell securities out of their own account to facilitate the trading of securities sometimes. So let's now look at how the sales department functions. There are two separate mini divisions within the sales and trading division. One of them is the sales department. So what happens within the sales department is that the research division schedules calls first thing in the morning before the market starts, the stock market starts, right? And what these sales guys may do is that they may attend a morning meeting with these research professionals as well as the head of research. Then they try to understand what would be the actual recommendation for the day to day. So, say for example, as I said, Microsoft may be a buy. So, when they hear the analyst out with respect to why it would be a buy or a sell, the sales job is basically to talk to the portfolio managers of the institutional investors and then explain them about the particular stock, why it would move up or probably move down. With this, the portfolio manager may decide finally on investing in a particular stock and therefore execute certain trades with the investment bank. So that's how these sales guys actually work. In between, sales guys are also responsible for constant communication between the research analyst as well as the traders from the investment bank. So as I said, research analysts are someone who prepare research reports with the buy or sell recommendation. The sales staff actually hears those recommendations and talk to the portfolio managers. And let's say if there's a $10 million or $20 million trade to be executed, the sales staff then passes this trade to the traders from the investment bank. Now, Let us look at how the trading division actually functions. So before we go into the detail, let's understand what is the objective of trading. Essentially, as I said earlier, traders need to execute the trade, that is, buy or sell securities on behalf of institutional clients and ensure that the execution price is minimal. So, they are the ones who are constantly looking at the price chart minute by minute, and they are totally using Bloomberg terminals and the trading terminals while conducting these executions. So, they trade on behalf of the institutional clients. And many of the traders, in fact, are kind of sector experts. Some of them may specialize in technology stocks, the others may be expert in FMCG or pharma, etc. So, this is the overall job of a trader, to find the minimum execution price for the institutional investors. So, with this, I hope that you now have understood how sales and trading department within an investment bank works. The next tutorial will talk about the main objectives of investment bank and how do they achieve it. Let's connect in the next video and learn how to raise capital through integrated investment banking services. Hello friends, welcome to this investment banking tutorial from Wall Street Mojo. Let us now move forward and look at another important function of an investment bank, and that is helping companies raise capital. And capital could be of different forms. It could be through an equity dilution, or it could be through loans. So investment banks actually do both. Well, before going deep into these options, let's try to understand what is raising capital and how investment banks help companies raise capital. As you can see, there are various companies that would be in need of cash to grow. It could be related to certain set of projects, or maybe, they may want to kind of expand their reach from national to maybe international platforms. So raising capital by corporates is one of the key activities that they perform. So they may approach a bank like the regular bank for different credit-based loans, but they may approach investment banks for a special set of needs. So what are those set of needs? Let's kind of understand while exploring its functions. When we talk about companies wanting to raise funds from the market, there would be an intermediary that we will call here as investment banks. So what the investment bank does is that it matches the investors on one side with the companies on the other side. And basically what happens is, once they match, the advisory fees or the commissions are actually taken by the investment bank. And that is why investment banking salaries are really, really high. Let's say if you have done a deal of raising capital to an extent of, say, $100 million, the advisory fee of an investment bank can be 2%, 3%, or 4%, and that could really mean big number. So this is a profitable business, as the advisory fees helps them earn a lot. As I said earlier, companies looking for capital hire investment banks as they have certain advantages associated with it. First is that even if the institutional investor is in New York, currently maybe operating in Singapore, or anywhere globally across Hong Kong, Sydney, or maybe London, investment banks have key network access to these investors who may be interested in certain set of securities or investments in certain companies. Secondly, they are experts in valuations. So let's say if the company wants to raise capital, they may want to share their own set of equity, right? So what is the price at which they can share their equity? That comes from investment bank. Thirdly, these banks play a very important role in negotiating between the parties involved. So think of buyers and sellers. So they come as negotiators in between. In addition, they also bring in their own experience along, because they help ensure all the regulatory compliances associated with it as well. So just to give you an example, when a company would raise funds from the public, there would be certain set of procedures that needs to be followed, or the regulatory aspects that needs to be looked at, right? Will the company be able to do it on their own with the limited staff? It will be kind of very difficult, and that's number one. And secondly, they may not be equipped with the right skill sets to actually go to the market all alone. So in most cases, in fact, in almost every case, you'll find that investment bank represents the company when they go to the market. So capital raising and going to the market can essentially be done in many different ways. Say the first one, which is again very important, is issuing of new securities. One example could be that of Facebook, issued its IPO for the first time in May 2021 as it wanted to raise capital for growth, and it did that, right? Likewise, Twitter had launched its IPO in NYSE in November 2013 with the same objective, which it successfully achieved, and in fact, it later withdrew as well in 2022. The tech giant is expected to hit the stock exchange with a new set of securities by 2026, again to expand its horizons even more than before. So that's what, issuing a new securities would mean. And these issuing of securities is represented by various investment banks. So it could be JP Morgan, Morgan Stanley, just to name a few. Second could be raising capital by issuing bonds. The reason could be various set of expansions that the companies may be looking at, or the aim could be to finance certain set of projects. Obviously, the reasons could be many, and investment bankers here appear as the best medium for representing these things to the market. So now that you have understood how investment banks help companies raise capital, it's time to discover how it is done. So as you know that one of the ways of raising capital is through equity dilution, right? So let's now look at IPOs and FPOs in a bit more detail. So let us now look at the meaning of what exactly the investment banks do when we talk about IPOs and follow-on IPOs. So when we look at IPOs, we are essentially saying that there's a private company or a privately held company. And let's say there are only limited number of shareholders who have actually started the firm. And let's call them as founders. Now, when a private company grows big, obviously they would or they may require funds to kind of finance their growth. There can be different tools associated with financing their growth. It could be that the bank may be ready to kind of lend the appropriate amount of money. If the bank is probably not in a position to lend it because the company is maybe too risky for the time being, private companies can still consider going to the market. Now, what does this mean? In the private companies which are closely held, it means 100% of the shareholding is between the founders and the initial set of investors. Now these founders and the initial set of investors are now willing to share their stake in the company with the outside investors in exchange of capital. So what do we understand by outside investors? Outside investors are general public investors like you and me, or maybe other institutional investors. So if that happens, we can say that the private company has gone public because they have shared their shareholdings with others like you and me. So this is where investment bankers come into picture. And the shares of this public company is basically then given to the public. So this share may depend on how much dilution this company would be looking at. So it could be 25%, 30%, 35%, and it will also depend on the amount of funds that they want to raise. Now, this brings us to another important question. Why an IPO is actually required? Is it required for growth? Is it required for acquisition? And what role do investment banks actually play here? They take care of the regulatory aspects, they find out valuations, they help in preparing prospectuses, and they also know the procedures, right? They know how to comply with the Security and Exchange Commissions, follow their rules and regulations, and all in all, they ensure that the IPO is successful. What do you mean by IPO being successful? IPO being successful means that the IPO was fully subscribed. If there is no investor interested in it, obviously IPO will not be successful. And that brings us to another important role of an investment banker, which is to basically spread awareness about the IPOs. Investors are kind of made aware of such an IPO, and investment bankers urge them to invest in that. So investment bankers work a lot on the IPOs, and they charge a certain percentage of the amount that is raised. So it can be really big at times for these investment banks in terms of commissions or the advisory fees. Now that the concept of IPO is clear, let's now look at what is a follow-on IPO. A follow-on IPO is just another set of stock offerings by the company which is already public. So say for example, there's a company who has already gone public and has shared around 25% of its equity with the public. Now they want to raise further funds. and they don't want it to do it through the traditional loan or banking where where the debt is raised. So instead, they want to share the equity with the public. So earlier 25% was shared. Now they want to share another 15%. This extra offering is the follow-on offering that may go public as a FPO. Again, an extra number of shares will be issued to the public. Here the public would know at what price these shares would come and what is the market price, right? And how would these follow-on IPOs are being valued at. So all of these information are very critically available, and investment banks help a lot again here to make the FPO a success. So with this, we have understood that the IPO leads to equity dilution, which means that the investors are normal retail investors. It could be public like you and me, or it could be institutional investors as well. But there is another category through which equity dilution can happen and where companies may not want to actually go to public. And this is called as private placements. Here you are just diluting your equity and raising capital through select investors. So what do these private placements mean? Here the companies actually sell their securities only to a small number of investors, not to general public like you and me, but maybe to a bank, maybe to mutual fund or institutional investors or an insurance company. This means that the small number of investors may invest large amount of funds to own their company, maybe 10%, 10%, 10% each, and make it a private placement. So this is yet another option towards raising capital. Here again, what an investment bank does is that they connect these institutional investors to companies and help them achieve their goal of raising capital through private placement opportunity window. Now you may be wondering, why would a company even look at private placements? So they could be due to certain reasons. The company may not be very big, or they may not have an appetite for an IPO. And not to forget, IPO comes with a lot of pros and cons. One of them being the downside is that if you list it, then you're answerable to more number of shareholders in terms of at least the absolute number. And you are then in the purview of SEC as well. And then you may have to make regular quarterly filings, minimum number of disclosures, and all these regulatory aspects are to be taken care of. Many companies, however, don't want that hassle and hence opt for private placements instead of preferring to go public. So that's about it for the reasons why private placements. And with this, we hope you have understood how investment banks actually help companies raise capital. Stay tuned for the next video of the series on underwriting and market making functions of an investment bank. Hello friends, welcome to this investment banking tutorial from Wall Street Mojo. Let us look at the overall framework. We've learned what is research, we've looked at sales and trading, we've also looked at raising capital. So now we'll move to underwriting and market making. So these are basically two industry jargons which are very important for us to understand. When we talk about IPOs, what happens is, let's say if the company is wanting to raise $100 million, and if they're unable to do so, then what happens? There is a risk associated with it where we probably assume that the IPO may not be successful. To mitigate the risk, investment banks actually underwrite an IPO, which means that if there is an undersubscription, then the investment banks will actually buy those shares. Let's take an example here and understand this in a bit more detail. Suppose there's a private company, a small one, that wants to raise capital using an IPO. But the problem here is that there may be risk associated with undersubscription. Let's say this company wants to raise $100 million from the market, and the risk for undersubscription here means that they're not capable of raising what they want to raise. So not 100 million, maybe they are able to raise 90 million. So that becomes an undersubscription. So here investment bankers who basically underwrite the securities will help the firm raise the committed amount. Here the investment bankers virtually guarantee that the amount that is committed to be raised will be raised. And how does the investment bank actually ensures that? So when the IPO comes, the stocks are given to the investors, right? And let's say if there is an undersubscription of any kind, let's say to an extent of $10 million. So these 10 million worth of stocks get absorbed by the investment bank. And in short, the investment banks will actually buy these shares and sell them at an appropriate time to make a profit. So underwriting will mean guaranteeing that any amount of undersubscription will be absorbed by the investment bank. Now, this absorption of shares involves a significant financial risk. The financial risk could be, let's say, if the IPO was not successful, the investment banks may have to buy this stock to an extent it was undersubscribed. And let's say if the stocks tanked after some time, that's a huge risk for an investment bank. And that's why when we look at underwriting, investment banks actually charge a hefty fees during the underwriting scenarios. And in this process, they have to negotiate in detail with the risk department as well as the compliance department about the amount of risk or the quantum of risk that the investment banks can take with respect to underwriting. So with this, we have understood underwriting as one of the most important functions. Curious to check out the market making activities of the investment bank? Flip through our next video in this series. Hello friends, welcome to this investment banking tutorial from Wall Street Mojo. Investment banks also enable market making activities in the stock exchange in addition to providing underwriting services. So what is market making and why investment banks actually play a very important role here? Market makers is someone who actually ensures liquidity in the market. Just to give you a very basic example here, let's say there is a stock called ABC. And there is an investment banker who is a market maker for this stock ABC. When there are trades that happen in the market, the role of market maker is essentially to provide liquidity to these stocks. And this could be done either by buying the shares or selling the shares. So let's assume that there's a buy side who is an investor who wants to buy, let's say, 1,000 shares of ABC, but his price is $50. Okay. Again, let's assume that there's a seller in the market who wants to sell this share of ABC, but he wants to sell it at, let's say, $100. And he wants to do that for 1,000 shares. So now, if we look at the difference between $50 and $100, that is the buying price and the selling price, that is too huge. So, the transaction may never get completed at all. Well, in such an instance, what happens is that there may be hardly any buyers and hardly any sellers of the stock. So here the role of market maker is to pitch in between and offer some lucrative price to the buyer or the seller and keep those shares for some time and then maybe trade them later for profit. Now, how do they do that? Let's assume that this is one of the cases. This investment bank who is a market maker actually offers to buy these shares at, let's say, $75. So we have a seller here ready to sell at $100. And then we have a buyer who is ready to buy at $50. But the investment bank who is a market maker has given a quote of $75. So at this point, there might be some sellers who might want to actually sell this stock at $75. Now, in this case, they may match the requirements and the investment bank who is the market maker will end up actually owning the share. So in this case, market makers has enabled the transaction of the security by providing liquidity in the market. So investment banks remain in between the buyers and the sellers, and it kind of creates the market. And on the other side, as it owns the stock, it can also look at selling the stock. So let's say this investment bank that now owns 1,000 shares can sell that at $80. So instead of $100, they can try to sell at $80. And in fact, they may find some buyers as well. In short, what investment banks are doing incrementally is that since here the bid and the ask spread was too high, as a market maker, they came in between and lowered the bid-ask spread and ensured that there was some liquidity in the market. Obviously, this example was a bit exaggerated, but the bid-ask spread can actually be very small, maybe a couple of cents. This way, market makers have really proven very efficient and have been helping in the smooth running of the financial markets. Now that you have pretty much understood much of the two jargons, underwriting and market making, let's move further and explore the role of investment banking in mergers and acquisitions in our next video of our investment banking series. Hello friends, welcome back to this investment banking tutorial from Wall Street Mojo. Let's move forward and look at the heart and soul of investment banking, that is the mergers and acquisitions activity. So every investment banking analyst may want to actually get into the M&A advisory role because it is kind of very exciting process which involves a lot of money. This video tutorial is dedicated to answering questions ranging from why M&A advisory role is super important and why people find it hottest field to work in. First of all, let's check what exactly an M&A advisory is. Firms that are interested in mergers or acquisitions look at the potential targets, or there could be sellers in the market, they may want to sell their company. But unfortunately, this is not something which is a liquid trade, where there are ready buyers or ready sellers available. Also, the company themselves may not be equipped enough to all the set of procedural due diligences, etc., right? So there are investment bankers that actually help companies execute M&A deals. So as you may be aware of, there are two kinds of M&A deals. One, it would be like a sell-side M&A deal, and this would mean, let's say, my company is on sale, and I want to sell this company at a reasonable price. So I may approach an investment bank expressing my concerns that I want to sell the company, and obviously the investment banks are made for doing these M&A deals. Likewise, there could be a buy-side M&A deal as well. There would be certain set of clients or companies who would be interested in buying potential companies that would add up not only in terms of revenue, but also strategically, therefore complementing in certain aspects of the business. But what exactly investment banks actually do in M&A deals? Investment banks primarily take care of different things. One, they analyze the target financial information. As experts in finance, they would dig deep into the financials and see how they are fitting in strategically. Number two is they conduct a lot of financial modeling and forecast and understand scenarios as to what is the amount of benefit a merger or an acquisition may lead to. They also help in assessing the core operations of the business. So they would actually go to company visit, they meet founders, they'll try to understand and evaluate the kind of synergies that are possible, and likewise they'll help in understanding what is the overall total cost savings that may happen once these companies merge. Or at the end of the day, they'll try to find out opportunities and areas of concerns and identifying risks and benefits with appropriate valuation numbers. So investment banks are adding a lot of value here when they also negotiate with the buyers and sellers and then essentially do all of these tasks. So with this, when investment banks actually pitch to their clients, they take their presentation to their potential targets and acquirers and suggest the client about whether they should acquire a certain company or not. So this presentation is commonly referred to as pitch book in industry parlance. And as an analyst or an associate, you may spend majority of your time creating these pitch books. So let's see in detail what these pitch books are all about and how they can be created and how important they are from the point of view of investment banking. Let's take a case where you are an investment banker and you're helping your client to identify potential opportunities for buying those companies. So basically, you are representing a buy-side acquisition team and you are helping buyers identify key opportunities in, let's say, emerging countries. In such a scenario, potentially you will have to look at many companies as such. So what is a pitch book here? A pitch book is nothing but a presentation made assuming that your clients really don't have any time whatsoever to look at the detailed conversation. So in one snapshot, let's say in 2 or 3 minutes, you need to provide key highlights to your clients regarding the acquisition opportunities, overall synergies, etc. So majority of the investment bankers spend a lot of time in making these pitch books because, when they go to the clients, they need to have something prepared for as a topic of discussion. So think of this as the first step forward to the client. And if the clients show any interest, then later point, you can always talk about it in detail, right? So basically in a pitch book, investment bankers provide a basic overview, high-level details about the potential size, valuation summaries, competition, etc., and why the acquisition is beneficial. As an investment banker, making a pitch book becomes a very important function as it helps clients decide whether to merge or acquire a company or if the deal proves fruitful in the long run. Stay tuned for the next video tutorial discussing the role of investment bankers in reorganization and restructuring. Hello friends, welcome to this investment banking tutorial from Wall Street Mojo. Now, the next thing to focus on is restructuring and reorganization of an entity in the event of bankruptcy. The two terms are very important in the context of those companies which are about to go bankrupt and are facing margin pressures or maybe cash issues, and they may want to organize very quickly. So they can take help from investment banks, and maybe investment banks can help them strategically as well by restructuring the financial aspects of their equity and debt. So investment banks have a larger role to play in this context. Let us now look at why investment banks are important when it comes to reorganization or restructuring of companies. What happens is many a times companies may not be doing really good in terms of its businesses and may be facing cost pressures as well. So they may not be even able to pay their own set of cash obligations which may be related to debt, etc. So these companies in such cases, let's assume, are on the verge of bankruptcy. So what these companies can do is that they can actually opt for either of the two or maybe a mix of both. One of them is restructuring and the other one is reorganization, which an investment banker can surely help. So let's first look at what is restructuring and how investment bankers can help in this case. So let's assume there's a huge debt on the books of ABC. A restructuring would mean selling a part of the asset to meet their cash obligations and paying off the debt. Second, it could be that converting a part of the debt into securities so that those who are bondholders, they would get the stocks in exchange of debt. Or it can also mean that the company can be entirely sold off. So investment banker can help restructure the original deal with the financiers and kind of find a midway out in between. So all this is done primarily to rescue the company from bankruptcy, which will ultimately lead to nothing but just a shell company where only the debt holders may be able to recover only a partial amount. So this is where investment bankers can actually be handy. Second, it involves around reorganization, which means that you're reorganizing the company's strategy altogether. So let's say earlier maybe the company was into emerging markets, but let's assume that it's resulting in massive losses. So investment bankers may strategically advise whether they should continue with this market or possibly look at other markets like the developed markets. So investment bankers actually take a role of a consultant. They analyze competition, help the management look at the new focus areas, and help them revive their financials. So it may also lead to change in management as well. So reorganization and restructuring are done by investment bankers for a fee, which can be a standard fee or it can be a fee which is based on performance. So that's where again investment bankers play a very interesting role. With this, we hope that you have fully understood the restructuring and reorganization well and also learned in what scenarios these options are applicable. With this video, we have come to the end of the functions that investment banks offer. There are various other aspects yet to be known. Let's check out the last couple of videos to understand the structure, roles and responsibilities of the investment bank. Hello friends, welcome to this investment banking tutorial from Wall Street Mojo. Now you know well how this field of investment banking opens wide array of careers, but when you're interestingly seeking an investment banking career, there is something more important for you to explore. Yes, the hierarchy involving different levels. It starts with an analyst, then you move to an associate level, then you become vice president, and then finally managing director. So let's now look at how these roles and responsibilities are performed within an investment bank. Let's take an example. Let's say there is a KKK investment bank, and if you look at an investment bank, you'll have these different positions. One of them would be called as an associate, there would be a team of analysts, then you'd have a couple of vice presidents, and there are a couple of managing directors as well. So what is the role of each and every one within an investment bank? Let's talk about the bottom of the hierarchy chain, that is the analyst. So what is the typical profile for an analyst looks like? So analyst is someone basically whose main role is to create financial models, do company analysis, do some hardcore data punching. So something like create a model from scratch, populate the historicals, do some industry research, perform some due diligence, and create pitch books as well. So essentially being an analyst is all about getting your hands dirty. Someone who is a graduate, let's say in history or maybe in finance, is eligible for this kind of a job. Now let's look at who is an associate. An associate's primary role is basically to check the work of the analyst. So they're one level up over and above the analyst. So that's why they are called as an associate. They write text for the presentations, they basically oversee the job of an analyst, and they also sometimes interact with clients as well as other investment banks as well who are presenting the other side of the party or the client. So they may interact with the client, but a lot of work is also needs to be done in terms of financial analysis as an associate. So think of spending at least 4 or 5 years after you join an investment bank as an associate before you become someone called as a vice president. Now, who is a vice president? Obviously, we are moving up the hierarchy, moving up the professional chain. So a vice president would be overlooking the analysts and the associates. But what is the key role? Now think of vice president as a project manager. When we talk about investment banks have to make a lot of client presentations and handle different kinds of verticals. Vice president is someone who is handling a certain side of a project. He handles the structure of the presentation before going for the meeting, how it should be looked like, design of a pitch book, etc. So all these things have to be managed, and he also talks to senior investment bankers and the analysts and the associate. So all in all, he's one of the most important guys within an investment bank, just below the final level that is called as managing director. So now let's look at what's the role of managing director in an investment bank. Managing director is basically someone like a father figure who every other person in the bank, looks up to. Now his responsibility is to develop and cultivate relationships. Assume that the managing director is highly networked, would be attending conferences, would be meeting clients, debating and discussing things about valuations, and going to high-level meetings. Managing directors may focus on one industry and kind of develop relationships with the management. And obviously, his primary role is to bring business to the company. So he's the one who is at the top and is handling the part where sales of business comes for the investment bank. Let's check out the structure of an investment bank in the next lecture. Hello friends, welcome to this investment banking tutorial from Wall Street Mojo. Let us now look at the structure of an investment bank. The structure of an investment bank is actually divided into 3 levels. Let's call this as front office, then there is this middle office, and finally we have a back office. So what does this front office, middle office and back office actually mean in this context? So when we talk about investment banking, core job of investment banking are where investment bankers are directly dealing with clients. So being in the front office means they are the face of the organization. When you're dealing directly with clients, you comprise a front office. Likewise, think of sales and trading desks. Sales and trading desks, as we discussed earlier, consist of those who actually directly talk to the clients and advise them on buy and sell recommendations of stocks. So since they're directly interacting with clients, they are considered to be into a front office kind of role. Likewise, research is also an example of front office role because they are also directly interacting with clients, recommending their own set of analysis about buy or sell on a particular stock. So we have already seen how research and sales and trading actually work in tandem to convince a client. So this is a front office. Now, what is middle office and who comes in between? So when we talk about investment banking structure, risk management team, they come in the middle office. What's the role of a middle office? This middle office key role is to interact with the front office and to ensure that they do not engage in any set of activities which are out of legal compliance, or it could be regarding risks that the investment bank may take during underwriting. Also think of controls and procedures, finance controls, compliance, and even the strategy team. All of them actually fit under this category and work as a part of the middle office. Now this brings us to the last thing, that is back office. So back office are those guys who are not interacting with clients. Examples could be that of technology team, reason being that they are not interacting with clients directly. For any role, think of whether they are facing the real clients or not. If no, then they can be classified either as middle office or back office. Also think of the operations team who are helping out in terms of smooth functioning of the business or investment bank, can also be termed as back office employees. With this, I hope you understood the structure of an investment bank and which function being undertaken falls into which category. Hello friends, welcome to this last lecture of the series on investment banking from Wall Street Mojo. Thank you very much for completing this program on investment banking overview. We designed this lecture series for students and amateur professionals who are still exploring the field of investment banking. Our only aim was to provide a brief view on the subject in a simple language and thereby make sure that the information and examples are easy to consume and remember for future references. We hope that you enjoyed this program as much as we did while we created this, keeping in mind that probably the audience is very new to this field of investment banking. We started with an assumption that you may not know anything about it, and that's why we started with the detailed differences between what is an investment bank like Morgan Stanley versus, say, a commercial bank like Citigroup. Then we looked at what equity research is. And while we were talking about research, we learned that research is all about doing fundamental analysis. It's about recommending clients which stocks to buy, which stocks to sell, and doing financial modeling. And if the clients get convinced with your ideas of buy or sell recommendations, then the client may want to trade on the stock, and this comes into action through the sales and trading department. So we learned all of these aspects in equity research, and we also understood what is a buy side and what is a sell side. We understood that buy side is someone who is an analyst, maybe sitting in an asset management company, and they are investing on behalf of their clients. On the other hand, sell side is the guy who is working in a research department of an investment bank. So he or she is selling an idea to an AMC or an asset management company or an institutional investor. So that's what we understood when we discussed buy side and sell side. Later, we moved on to the sales and trading division, and we understood here that the equity research department and the sales and trading department, both of them work in tandem. And on one side, research leads to sale of ideas. Once the ideas are sold to the clients may want to execute these trades, and these trades are executed through sales and trading division within an investment bank. And for these trades, the investment bank charges commission. Another aspect of investment bank was helping companies raise capital, and we saw that IPOs and FPOs are one way in which companies can raise capital through equity dilution, and this equity dilution leads to ownership by public. And then there is this private placements where the companies may want to dilute their stake, but only to a limited number of strategic investors. We also understood what is underwriting and market making. Underwriting is something like the risk of undersubscription, and investment banks mitigate those risks by guaranteeing that there will be no undersubscription. So for this, they charge a higher advisory fees. Then we discussed market making as well. In market making, investment banks actually participate in buy and sell transactions and take positions so that the markets actually behave in an efficient fashion. We also understood that important activity of an investment bank is with respect to helping companies identify the potential acquisition targets as well as finding those companies that want to sell their stake. They make a lot of pitch to the clients and prepare a presentation known as pitch book. We also discussed how pitch book can be a handy tool for investment banks. Just in 2 or 3 minutes, a pitch book can give a snapshot of how fruitful an M&A deal can be. And lastly, we came to know about restructuring and reorganization, where there could be companies that may be facing challenging situations or cash crunch or strategy related issues. So investment banks actually help them in 2 ways. One, they can help in reorganizing their own structure, strategy, changing the CEOs, etc. 2, they can also help solve cash crunch issues by restructuring the debt or maybe selling companies' assets to reduce the overall debt. All these activities are taken care of when we talk about restructuring and reorganization. Overall, what we learned is that the investment banking is a very interesting field and it works in a very integrated way. So it's very important job, and if you want to make a career in this field, you have to be pretty serious about it and maybe open to spending 12 to 16 hours a day at least for a minimum of 3 to 4 years. In case you're looking forward to expanding your knowledge in finance even more, and becoming an unbeatable finance professional, you can enroll in our financial modeling and investment banking courses, which will provide you with the step-by-step training on these tools and techniques. These investment banking training programs are exactly the same training program provided at top-tier investment bank. Thank you so much and have a nice day.